Bloomberg Audio Studios.
Podcasts, radio, news.
For more on what to expect, we are joined by Sheila Bair. She's the former chair of the FDIC, of course, especially during the financial crisis, of course, the senior fellow at the Center for Financial Stability. And you think a lot about Dudley's comments here was really rooted in the worry about a recession if you did not see a rate cut soon enough. Do you share those concerns?
No, I think the Fed's handling it right. It sounds like they're going to stand pat next week. They should. A lot of this is just reverting to pre-pandemic norms. So it's, I think we want to, keep our heads here and not unduly panic. And I do think, not certainly with Mr. Dudley, who I have a lot of respect for him, worked with him a lot during the great financial crisis, but I do think a lot of this Wall Street clamoring for rate reductions is really more, they're saying it's for Main Street, right, get those credit card rates down, but it's really for them because that will boost their asset valuations, maybe generating some refinancing income, they've got distressed borrowers, help them. I mean, it will be a clear boon to Wall Street when rates start to go down again, but it's not clear it is for Main Street. What Main Street is hurting, those credit card balances are high because of inflation, because it's more expensive to live these days. And that hits everybody, not just borrowers. So I think the Fed is handling this right.
Well, Sheila, that's so interesting to hear you say that, because the point has been made again and again that the medicine is worse than the illness at this point. You're taking the opposite view here, that actually, no, inflation is the main thing that consumers are suffering from right now. It's not necessarily those higher interest rates.
No, I don't think it is. And, look, rates are not high by historical standards. These are kind of normal interest rates. And there are benefits from higher rates. You get more disciplined capital allocation. You reduce incentives to lever up. And that's painful because we had a lot of leverage build up during the long, protracted era of ZIRP. And so people are having to deal with that now. But higher rates are actually productive for the economy. Low rates hurt productivity. There are a number of academic studies that show that. So there are economic benefits to it. And but I also think any kind of incremental reductions in rates, and I think at some point the Fed can nudge them down a bit, but how much that's going to flow down to help Main Street is a question for me. And I think the real problem is we've had some real wage growth, thank goodness, but things are more expensive. We need to focus on real wage growth as a way to empower consumers, just not more debt, whether it's, 25 basis points less or what have you. And housing, mortgage rates, which is the other area that Wall Street targets, that is a supply problem. You lower rates, fine. You're going to juice demand. It's still supply constrained. You're just going to get home prices going up more. So that doesn't help Main Street either. So I think we need to look at the root causes and stop, saying that monetary policy is the solution to all these problems.
I mean, higher rates should also encourage more savings, right? Theoretically, you've got a rainy day fund. You're getting 5.5% on your CD or whatnot. Sheila, I wonder, though, about your confidence in the Federal Reserve's independence. Some people running for office right now may want to weigh on the Fed more heavily than others. Yeah. Are you concerned about Fed independence?
Well, I am. I mean, Mr. Trump clearly is not going to be respectful of Fed. He's already, pressuring them to he doesn't want them to lower now. He wants them to lower when he becomes president, if he becomes president. So, but I have a lot of confidence in the current Fed. I've not always agreed with them, but I have never questioned that they have political motivations behind the decisions they're making on monetary policy. So I do, it's going to be all about the leadership. But if Mr. Trump comes in, there are strong statutory protections against Fed independence. I think if he tries to assault that independence, there could be a significant legal barrier to doing that. And if it's Kamala Harris, and if she wins, that's kind of an unknown. Mr. Biden has respected their independence. I hope she would continue to do the same.
I want to switch gears here and talk to you about an opinion article that was written in Politico this week, and it's entitled, "Why is the Government Encouraging a Taxpayer Bailout?" The idea here is that mortgage origination and servicing has really moved out of the banking system. This is the system here, of course, that the federal regulators really oversee, and out of the purview for the most part from these regulators. Just this week, one of the companies named, Mr. Cooper, became even more powerful by buying a set of assets from New York Community Bank, arguably embattled a little bit at this point in time. How do you feel about this move from the banks to the non-banks and the move by regulators to really try to backstop this system?
Yeah. Well, I think it's unfortunate. It bears repeating over and over again that the majority of these toxic subprime loans that cause so much heartache for families and so much disruption in our markets, the majority were originated by non-bank lenders. So the irony that they go from about, 34% to two-thirds of mortgage originations now is supremely ironic, and the servicing has moved too. It's about 4% during the crisis. Now it's well over half. So this is a problem with bank regulation. When you just clamp down on the banks, and capital requirements on mortgage servicing rights, I think, are part of the reasons why the servicing have also moved to the non-banks. But you just force this activity into less regulated sectors, and then to have an answer, okay, we're going to clamp down on the banks, we're going to push this, and not to say we didn't need more capital, we did, of course, but you can't do that in isolation without paying attention to kind of risks that are being created when it moves out of the banks. So this is a problem. They need more prudential supervision. They don't need bailouts. And there are plenty of tools now. I used to be the chair of the Fannie Mae board. Fannie, Freddie, Ginnie can set standards. They do set standards of financial integrity. Their businesses are at risk if these mortgage servicers get into problems. They could strengthen those requirements. FHFA could help them with that. And so I think there are current tools. It would be great if Congress provided more direct regulatory authority over them. But pending that, I think the tools are there now, and that's where the focus should be, not on creating bailout funds.
Right.
I mean, that's just, if the Fed thinks or FSOC thinks Mr. Cooper's is systemic, there's a process called Title I designations. They can designate Mr. Cooper's as a Title I systemic entity, put it under the Fed's supervisory regime, make them have a resolution plan, increase their capital requirements. Those tools are there if they really think these servicers are systemic.
I think this is an important conversation because, I did ask at one point, even J.D. Vance, if the private equity community and the private credit community and the non-banking community at large needs more regulation. And he agreed, for example, that there should be more. So, there's another story in the Financial Times about how private equity has been tangled in a web of bank debt. Bloomberg reported this morning that there are banks looking to restructure one of those debts, for example, Brightspeed. They might be stuck with losses on their books. Is there a deeper connection than meets the eye between the private community, non-banks, and the banking system that regulators are not privy to?
Yeah, I think there absolutely is. There's a real lack of transparency around what the exposures are on these private funds. My gut tells me they use leverage on leverage. The conventional wisdom is they rely much more on equity financing or less leverage than banks. I don't think that's the case. And here again, banks have tremendous lending exposure to them, as a lot of the the lending and other financial services have moved out of banks driven by the capital regime and the lack of those capital requirements in the non-banks. This business has gone out, but the banks are still lending to the private funds that are now doing this. But the capital treatment is more lenient because they basically do it on a collateralized basis. The exposures are structured differently than just making loans and holding them on your balance sheet. So again, it's a phenomenon of only slapping regulation and tougher standards on the banking sector without looking at what you're doing on the non-banks. And at very minimum, we could impose tighter requirements, things that the banks should know about those private funds, having a holistic view of their financial position, not just looking narrowly at the collateral. And gosh only knows, they probably bought that collateral with the loan. Who else has a claim on that collateral? They don't have good. The banks don't have it. I don't think the regulators have it too. And I think FT had a very good piece on this, kind of breaking down all the different financial engineering that's used to pile leverage on leverage in these funds. And it doesn't, we talk about recession risk. I worry more about that. So much private credit has shifted into the non-bank sector. And if that sector implodes and that flows back into the banks, then we are going to have a real problem. Then we are going to have a deep recession along the lines of what we had in 2008.
Unfortunately, I have to leave it there, but something to rediscuss very soon. Sheila Bair, formerly of the FDIC.